think the first realistic question everybody has to give me an answer to is, what are your expectations? What are your objectives? What is your real need? Everybody has an idea, no, I can live on X amount. But when I say break it down, give me your budget, they don't quite get there, or they exceed it. So your starting point is always key. Where are you exactly? How much are you saving? What do you consider to be your retirement plan? Most people, when I ask them, what is your retirement plan? They say, oh, I have a pension fund, or I have a provident fund. And they think that is their retirement plan. And that's their first big mistake, is that a retirement plan is much broader than one product. And the next thing I need to know is, how much do they actually believe that they'll actually have enough? Because if they believe they will, then they probably have the right behavior. If they don't, well, then I need to look at what they're spending their money on. Because a lot of people live a very extravagant life and get a serious wake up when we do a retirement forecast that they will never maintain that kind of lifestyle into their retirement years, because they've got expensive habits. Their children are costing them a lot more than maybe that they cost their parents. And we really dig deep into their budget to understand what it is that they're going to need in retirement. So it's a very broad departure point, and then we have to look at all those variables, the tax rates, their structure, the trust, if they believe in the trust going forward with changes coming. How do we undress that, and how do we deal with it? Market risks are obviously very important, so we have to look at asset allocation. That is key, because 90% we always see in the forecasts of your return comes from having the correct asset allocation. So it doesn't matter what product, it doesn't necessarily matter what share, but did you have the right asset class? And those are things that we look at very closely. I think young people need the discipline, the financial discipline. So to shock them into showing them the shortfalls that older clients might have, but we'll show them the power of compound growth, the difference it would make if they were to start now rather than trying to catch up when they're 35. A lot of young people think that retirement planning starts at 50 and they will get to their goal by some miracle at 65, because suddenly they won't be paying their children's school fees, varsity fees, etc. The reality is that the behavior of today's society is you replace those with new expenses. And people living beyond their means suddenly get to retirement and have a big wake up, and they've got to scale down, sell the big house, live in a small retirement home, can't go on those holidays they thought they would in their retirement years. So dealing with young people, we need to show them those long-term things, show them the growth forecasts in good years, and how that can change their lives later. And whether it's starting just with an aggressive unit trust or a conservative one, saving for that first deposit on a house, that they can get into the property market and rather own their house than pay rent all their life. Getting them to understand what investments mean is our challenge. And I love that initial debate and getting them excited, showing them good returns, but showing them the reality of bad returns as well. And what that means is it's special. The shops are having a special, you rush out and go buy 2 of the same item. Well, when the stock market falls, it's a special. Go and buy those quality companies at half price and build up your portfolio in tough times. Don't just think every year is going to be good. But it is a big challenge to find that extra bit of money in the budget to save it for retirement. It's a fantastic time because you're actually spoiled for choice right now. The last year we've seen single-digit returns. We've seen single-digit returns in certain sectors now for 3 years. And you're not buying companies at highs in terms of price. If you believe in the PE ratio as the only indication, well, then you're not going to buy anything because the PEs are high. But that's simply a factor of price divided by earnings. So whilst there are no earnings, the PE will be high. And the price, if that's an acceptable level to you and you believe in the company's growth plan, then by all means buy it. Whether you're buying onshore or offshore, whether you're buying property or equity, those are the questions that we would guide you through. probably not going to buy bonds right now, given the interest rate cycle. Cash, yes, it's a positive return, but the minute you adjust for tax and inflation, you've gone poorer. So you have to be investing in growth assets, and this is a good time, but phase in. Don't go and buy everything in one shot. There are tremendous volatilities, and this year has been the year of the unexpected, and expect more of it. So we welcome the opportunity. They always say that times of volatility are great for quality managers because they're getting cash flows and they can buy assets that they previously thought were expensive. The poorer performer is unfortunately going to be under more pressure. He's going to be losing assets, selling good assets at low prices. So who you're with is also important.